Bart Welles, principal in Pacific Capital Mortgage. Good morning, Bart.
Morning, John.
Before we start, I know a little bit about your background. I know you crank out between $8 and $10 million a month, and a very high producer, own your own company. We'll primarily be talking in terms of production. The listeners out there will be primarily the 30,000 or really 90,000 loan officers out there, and they will be focusing more on the production side of the business. And before we get started, I always like to start off because people seem to have, as I like to say, a primal interest in where people came from and how they got started. And so I wonder if we could go back in time a little bit and you tell us a little bit about yourself and where you came from and how you got into business.
Yeah, I started in the mortgage business in '94. Really got started in '95, and prior to that, I had a little investment partnership, and we were buying and selling single-tenant, net-leased retail investment properties, and that market kind of dried up because we were buying them from leveraged buy-out retail companies. So I started going through the RTC defaulted loan portfolios and talking to banks about REO properties, and sort of got led towards the debt side and started looking at defaulted loans and came up with a formula for buying defaulted loans, and I raised some money and had a partnership to do these deals. And that market over time matured. There were more buyers. The yields went down, but it got me interested in the debt side of the business, so I decided the thing to do was to originate mortgages.
It's interesting. I knew Joey Robert, got into doing that, buying properties on a massive scale. As you know, he's made himself a billionaire doing that kind of stuff now.
Yeah.
But that's kind of an interesting path. Did you grow up in California and go to college here?
And I moved here about 14 years ago.
Mm-hmm. And how did you decide to actually get into the purchase money origination business?
Well, I was really looking for another avenue when my marketplace matured in the buying defaulted loans. Mm-hmm. These banks had shed their assets from the prior downturn in the real estate market, and I like real estate, and I realized I liked loans, and I liked underwriting loans. And I had been underwriting loan files that were 10 or 20 years old that had gone into default. So I was backing into, these transactions. So I thought, gosh, it would be pretty easy to see a fresh loan from the start with taxes, new credit, and current
good people. Right.
Yeah, this would be an easy way to underwrite a deal. So that's basically, it was just a natural evolution to go that direction.
Did you? It's interesting. I find it very interesting because you obviously, in a very short amount of time, have produced major amounts. And I'm curious, when you got started, how did you start? Did you start as a loan officer? Did you start hitting realtors?
And I worked for a company that's now folded into Fleet Mortgage, but I went through their training program. It's been a lot of 94 and the beginning of 95, just learning.
Mm-hmm. Did you
chasing realtors during a big refinance market? But I was trying to be strategic and build long-term relationships.
Right. Yeah. Well, we all know what happens to people that put total emphasis on refis. You know, they're not going to be listening to these tapes. They'd be pumping gas someplace.
Well, I think that part of that depends on how good of a job they've done in building relationships.
Yeah, absolutely. Yeah, absolutely. But, there is an old saying in this business that, you rely too much on a refi business. So refis come and go. And when they go, and if you don't have your purchase money business and your realtors in place, lots of times when you walk in that office for the first time in 6 months, they don't know who you are.
Yeah.
And, anyway, to get back, when you started with realtors. How did you go about getting your business initially?
And this was part of the training that I got at Plaza, but really we segmented the market to the top producers and started cold calling them, and it was kind of rough. But cold called them. We were touting pre-approvals at that time, which was sort of early on in the formal pre-approval process.
Sure, pre-qual.
Trying to basically add value, giving them ideas on how to improve their business, predominantly based around give us your clients, let us get them approved, don't waste your time until you know they're ready, and then your client can shine above the other offers if they have formal loan approval subject to, appraisal, title, and purchase contract. So I had a list of about 25 and whittled it down to a dozen that I was able to build relationships with. And I sent them direct mail. I cold called them. I went to their open houses and just tried to get to know them.
How did you get around the front office? And I'm saying this for the benefit of those new loan officers out there that have a tough time getting through the realtors' offices.
I think the best way to do that is to call them, send them to mail, and then go to an open house. And the open houses are hit or miss because the big producers often have assistants there. But you start to see a pattern that often the realtors attend the first open house. So when I'd see a new listing pop up with one of the agents on my list, I'd make sure I got to that open house to see if they were there.
I talked to someone last week in an interview that did exactly what you did, and they would go through the book and they would match up the phone numbers, the office phone numbers, with the offices, see if it hit their office that they had, and those are the ones that they would go out and visit. And there's kind of a rule of thumb in that new home business, or on open homes more properly, and that is, if there's nobody there, they have all the time in the world to spend with you.
Yeah.
When they're talking to a client, you got to move to the side quick.
Oh, yeah, absolutely. You have to be very sensitive.
Was that the only way you got your business? I'm sure.
That was what I did for a year, and that helped me get a pipeline going. And then I started doing direct mail because we were still in a low-rate environment, and I did direct mail for focusing on no-cost one-year Treasury bill deals on loans over $400,000. And living in the Bay Area, the average loan size here is quite large. So that was quite effective at the time. It's no longer effective simply because when your Treasury bill deals are no longer available at 2 points below a 5-year fixed.
Sure.
So, and the rebates have gotten short, and the lenders are imposing prepays on good pricing. But at the time, that was an effective way to build a client base and a pipeline.
Would you recommend that somebody use direct mail today?
I think direct mail's great, depending on the market and depending on what one's targeting. Direct mail is kind of an elusive thing. In a refi market, it's extremely effective. In a market like this, it's a lot harder, and it's hard to get a yield on it. And you have to go after debt consolidation or back into actual interest rates and try to target specific loans. But a blanket direct mail in this market's not necessarily a good use of money.
I think that, there's a case to be made. You're starting to see some major articles being written on it that we may be entering a phase. Well, we are going to be entering the phase. The only question is how fast it takes over, where you're not necessarily going to see refis anymore. Because of some of the new mortgage instruments that are going to be coming out over the next couple of years.
Oh, I think there'll always be refis.
Well, some of the instruments, I know Countrywide, I think, was developing.
Countrywide's pricing's terrible.
Yeah, well, the key is to be able to refi without any closing cost and to be able to refi to a good rate. I think if they can ever put all those pieces together, I think you, over a period of time, will see a refi market greatly diminished.
Possibly.
You don't agree?
Well, I just think that a lot of the Countrywide instruments, it remains to be seen how they're going to price them. Are they really going to cannibalize their own portfolio? Are they truly going to be the most aggressively priced? Maybe it'll work for small conforming loans where closing costs are high, but on large jumbo loans, no one lender consistently leads the market.
Yeah, right.
Countrywide's so far out of the market.
Well, even when you look at Tom LaMouth, who owns Wholesale Access, is one of my partners, and when you look at some of the segmentation of the marketplace with wholesalers, there's very few. I don't think anybody has over 7% of the market.
Which is wonderful.
Yeah, right, exactly.
It's interesting.
Although there has been a consolidation in wholesalers.
Oh, yeah, particularly, and even more on the servicing side. But
well, that's because of efficiencies.
Right.
There's certain breaks. I'm not an expert on that market, but if I remember historically, there's a major break at like $600 million, and then there's steps in the efficiencies where, once you really get cranked up, you are really hauling the cash in.
Yeah.
Unless you bought your servicing at a pretty high rate, then you're not in business anymore. But if you can originate it and put it on the books, and certainly in the last couple of years with the rates being what they are, the runoff is going to be at a very acceptable level. I mean, a lot of these major services can make a lot of money. Let me ask you something. In the business that you're doing today, is it primarily realtors that you're dealing with?
It's a blend of realtors along with prior clients.
Mm-hmm. What percentage is realtors right now?
40.
About 40%?
Yeah.
Do you still call on the offices
No.
now that you've been around a long time?
I don't, because I have enough calls coming in from my prior client base and from the realtors that it pretty much keeps me pinned to my desk.
Your average loan amount, I suspect from a couple comments you made, are pretty high.
$450.
$450 is your average loan amount. I just finished doing an interview with someone who does about 500 loans a year, and their average is $81,000 in Lynchburg, Virginia. Which can make for some real long days and nights.
Yeah, although they're probably getting 2 points on this.
She actually does a lot of FHA business, so maybe there is a little bit of overage in the deal.
A little bit of a trade-off, yeah.
Yeah,
and also more often the smaller loans are salary-based borrowers, so there's less underwriting. A lot of my borrowers their income is a blend of salary, stock options, interest, dividends, and capital gains, or else they're self-employed and they own one or more entities, so there's more underwriting and documentation required.
Well, that's an interesting segment of the market, and I don't often, although I have certainly, interview people that deal exclusively in a market that's like 450 and over. So I wondered if you would discuss that market for the loan officers out there that'd be interested in entering that kind of market, what they're going to face. Because I do think it's almost a subspecialty. You brought up a couple things already with the self-employed.
Well, I think it's a great market because the typical borrower is sophisticated, and you're not explaining loan programs. They tend to know what they want. They tend to be very interest rate sensitive, so you have to sharpen your pencil and really pay attention to the competition, particularly the internet players. Although they haven't captured market share, people do use them as a benchmark.
Yes, they do.
So when I'm pricing loans, I'll often do a little survey, just find out how they're pricing. And often I can match or beat their price and get a point. And sometimes I get carved back. Occasionally I get carved back to a quarter of a point, but that's rare. Normally I'm able to maintain a margin of 3/4 to a point on purchase transactions. In terms of dealing with the borrowers, you have to have a good understanding of underwriting in an effort to have one conversation and request the right documentation so you don't come back to them and piecemeal them. That tends to erode your credibility.
Okay.
So in an initial interview, it's not brain surgery, but I just ask the right questions that are specific to give me a command of what their income blend is and if they own entities.
Like more than 25% of the company and things like that.
Yeah, and are there K-1s on their taxes, and is there other real estate, and just to try to get a snapshot in my mind of what their tax return is going to look like before I start asking them for stuff, so I can give them a complete list. So when I get the package, I don't have to go back and say, oh, geez, I didn't ask for K-1s, or, ooh, I need that 1120 because you own more than 25%, those kinds of things.
Do you get some resistance in asking for that kind of material?
Sure, but I try to explain why, and enlighten them as to what happens in the underwriting process, and that we are averaging over 2 years. If they own more than 25% of a company, that we need the corporate return because it could actually be negative behind the scenes. And so I try to really help them understand that sometimes they're mad, and then I immediately shift them to a no income deal. And I say, hey, that's fine. You don't have to give me all this stuff, but depending on how stuff's priced in the market, your rate's going to be an eighth or a half higher. And just fill out the loan app and give me some asset stuff, and I'll get it done.
You raise an interesting point here. It actually is where I was headed. Do you find a lot of people that once you explain the amount of paperwork that's needed for especially the self-employed at that level, that they try and switch into either no income or no income, no asset type deals?
No, because they're rate sensitive. Often they have a high net worth because they're fiscally prudent, and they want the best rate. And I tend to some degree, I tout rate too, and explain to them the benefit of me as a banker, broker, that what I bring to the table is the spectrum of programs, and I'll find them the best deal. But very rarely will people, in the end, resist giving me stuff, unless for some reason they have a relationship with another lender that goes easy on them. And then I sell rate, find out how the pricing is, and try to beat it.
There's something interesting. I was talking to, it wasn't Scott Cooley, but it was probably somebody you know, a couple of weeks ago, and we were talking about the Internet, and your first observation is correct, that there are a lot of people, especially in a sophisticated level, who are using the Internet, but they're really using that Internet as an informational thing to come back and then beat up on everybody else that they know exactly what the rate is. But the response that I'm getting from people that I interview in your range, and actually even below, is that when you add it all together, a lot of these Internet companies are coming out with pricing and points that look very attractive on the surface, but once you start looking into their closing costs and their extra costs that they're throwing in, that advantage is evaporating. That's the first observation I would make. The second one is one that Scott Cooley made, is that these Internet companies, they still have to process that thing in the back door, and they do not have any magic secrets to getting efficiencies out of that.
That's true. They don't. Consequently, the profitability is in question if they're pricing lean.
Exactly.
And they have their front-end technology costs plus the marketing costs, which is why a number of them have gone dark.
Right, exactly. There was an interesting thing. I set it aside. I'm looking for it now. I can't grab it quick enough. But it was the cost of obtaining a new customer on an Internet-based, a .com company that has no bricks and mortar, and it's somewhere around, I think, $49 a client, where .com companies that have a mixture of the .com and bricks and mortar, their cost of acquiring a new customer has dropped from $22 to $14 in the last year. So I think some of these Internet companies that are
low, though.
Pardon me?
Those costs seem low. So a new client that closes is just a hit.
This is a new client. No, I'm not talking about the mortgage market at all.
Excuse me.
I'm talking about no. I'm talking about business in general. But I think the trend is clear in what you say, that the pure Internet plays out there, that their costs actually, I think, are going up in many cases.
They are. And if you look at the packaged goods, they're often having to waive shipping, which if it's a small ticket item below $50, they're upside down. And furthermore, they have to offer extreme discounts to drive traffic, and then they have to pay to disseminate the information, and the advertising's expensive.
Right, exactly.
So yeah, a lot of the models are upside down, and that's what you've seen recently. Well, 3 weeks ago, in the industry standard, one of the trade regs for the Internet business really hammered on retail, and a couple days
they're
later,
dying.
A couple days later, the retail Internet stocks went through the tank.
Yeah, if you didn't sell eToy short, you're in big trouble right about now.
Yeah.
So no, I agree. But back on to the type of loans that you do. You say that you get about 40% of your business directly through realtors, and the rest is now coming through referrals. Which kind of indicates to me that you do you keep a database? Do you use ACT or one of the other management systems? Or
I use Access, and I have a very specific database that I have tracked every loan I've ever done.
That's very...
I know the loan size, who the lender was, interest rate, margin, life cap, prepay. I know who the referral source was. And now, in the past year and a half, I even know when I locked them, how many different lenders, when the loan closed, how much I made on it. So when a client calls me, I can very quickly, I just have a printed list. I can very quickly grab their list, and they say, do you remember me? Mr. Jones, I did a loan with you. And I can go, oh, sure, yeah, we did your purchase loan, in San Francisco in July of '98. And, I can go right to it and make them think that I'm really on top of it. Another thing I do is I keep my loan files around. I have boxes of them. So I can quickly put someone on hold, grab their own old loan file, and talk very intelligently about their next option, whether it's an equity line or another purchase.
I find that very interesting. In every interview that I have ever done, I have always come up in the interview with something that's new. And the first thing that strikes me, you were the first one that I've talked to. Most of the people I do talk to are pretty sophisticated, as you can imagine, and they all use ACT for the most part. I use it. I love it. You're the first one that really has gone into a level of access, and I understand access and what it can do, and you must have a very sophisticated system.
We do. I've actually built a loan tracking system. So, and it's overkill in a market like this, but in a refi market, if you're trying to close 20 or 30 loans in a month and rates drop, you might get, 20 or 30 or maybe 50 calls in 48 hours, people asking if they can relock.
Mm-hmm.
That's why I did it, actually, because it took me so long to shuffle through the loan files and return people's calls that I was behind the eight ball and I was missing business. Whereas this way, I could pull up my sheet and just say, you're locked at X, I've relocked you, here's the new rate, don't worry about it, and try to get off the phone. Or explain to them that the rate couldn't be beat and give them confidence to that so they'd leave me alone.
Mm-hmm.
But through that, we've developed a number of reports, inquiries, and ways of tracking things so my assistant can enter information. And now, for the past year and a half, every time we send out an app, the first thing that happens when I give him the information is he punches it right into the computer. So I know who...
In access.
Mm-hmm. App went out.
And just have query screens, I guess.
Yeah, and then I can go back in and track it and see if I've gotten the app back. And try. So I'm trying to maintain not only a database of past clients, but a database of everybody that's ever called me. Because occasionally I'll get a call from someone that'll say, I talked to you 18 months ago, and you were really nice, and you offered this, and I ended up not getting a loan, or I did a loan for someone else for these reasons, but what do you think about my scenario now? And that's made me realize that I was missing out on many people that had lost my name and address, and if I had a way of mailing to them once a year or twice a year, that I might capture more referrals.
It's kind of interesting you say that. I interviewed pretty heavy hitter Rod Flowers, you may know him, on the East Coast, and he says that his clients they want three things. They want a quick response, if I remember, they want prompt attention, and they want simple solutions. And I think when you have an access database like that, you can give them all three. Yeah,
it certainly helps you. Often with my clients, there aren't simple solutions, but they're smart enough to figure out why I'm doing what I'm doing.
Mm-hmm.
But being able to be responsive is key. Being able to be knowledgeable and be acquainted with their prior transactions builds a lot of credibility.
I think in that business, and correct me if I'm wrong, having an in-depth knowledge of how self-employed people work, and certainly an in-depth knowledge of tax returns and how to read them, I think that's paramount.
It's critical.
Maybe you don't know how to do that.
There are tax classes that can help people with that. I happen to take a number of tax classes in college, so that helped me. But yeah, it's really important. Really, really important to understand taxes and the flow and what's going on. And frankly, you don't necessarily have to be able to do the full underwriting, but to be able to grab a tax return and pour through it and understand the big picture and how you're going to capture enough income to qualify them, or the fact that you can't, so you need to convert the person to a stated income loan. It's just so important, because if you're sitting in someone's office and they hand you their taxes, you need to be able to rip through them and give them a response. And if you have a problem with their taxes, you need to explain to them why. And often a processor that's not as astute with self-employed underwriting may miss stuff that you might get, or it might help you understand what's not flowing through the taxes, so you can ask the client a question, or maybe go to their accountant and ask them a question.
Correct me if I'm wrong, it almost sounds like at that level that you're dealing with, that you're almost operating as a certified financial planner. That you really have to...
That's a little bit of overkill. I occasionally have been asked if I do that, and I refer them off to a money manager.
No, I mean in the narrow scope of what you're doing in terms of analyzing their income and being able to pull money out, but also being able to say, we don't have enough here. We got to go another way.
Yeah, I do, at least from a real estate finance standpoint, try to advise people. And I'm very current on IRS regs, so I can talk to them about their alternatives and the impacts of using mortgage debt versus using off-balance sheet debt for whether it's home financing or for their business or for investments.
Do you find that that comes back to you and with realtors that will use you primarily because you obviously built up this knowledge base?
Well, with the agents, I like middle-aged, very honest and upfront, seasoned real estate agents with a typical client base of 40 and older. And I think that my knowledge brings credibility to the table, so they're comfortable referring me to anybody, whether it's a first-time home buyer, but more importantly, if it's a CFO of a company, they know that I can relate to them on their level and ask good questions, and in the end, the impression will be strong, so they won't look bad because they referred somebody that doesn't know what they're doing. And I think my knowledge also breeds credibility in transactions because I'm real cautious in the pre-approval process and what I allow and don't allow and will and won't say or write relative to loan approval. And I think that, in my market, real estate values are going through the roof. Everyone's getting very leveraged often to get into homes before they've sold their old house. So you've got to be careful. And many pre-approval letters are, although they're written, people are getting into contract without any loan commitment. So you're out on a limb. And the real estate agents are out on a limb, the borrowers are out on a limb, and the agents need to know and feel confident that you're not pulling their leg and you really have your hands around the deal and it really is pre-approved, or at least at a minimum you know how you're sure you can get it done.
Well, there's a difference between, if I can split a hair with you, between the old, when I was doing business, I'm 57 now, but years ago, the pre-qual letter, which we used to call the BS letter. You had these giant holes that you could jump, subject to credit and subject to this and subject to that, with actual pre-approval letters now where they're really only subject to an appraisal.
Yeah, appraisal, purchase contract, and title report, typically.
And
I had one transaction where I had written a pre-approval letter and hadn't referenced anything about a gift, and in fact, this guy was buying a $1.5 million house, and he was getting a $400,000 gift from his parents for the down payment. He got under contract, removed his contingencies, decided he wanted out of the house, so came back and said, gosh, my parents won't give me the gift. So
I love this.
It ended up being, the whole thing rested on my shoulders.
For sure.
And it happened to be a real estate agent that was selling her own house that was livid and said, why didn't you have those assets verified? And what I'd said in my letter was I had documentation relative to the down payment.
And we're parsing words here.
Potentially did not say they'd been verified. So we got into splitting hairs in my language in a pre-approval letter.
I went to an English Benedictine monastery for high school, and one of my great courses was in English where we would have to parse sentences to the 10th degree, and it sounds like it served you well.
What I've done is I've actually put into the letter that they're pre-approved, and I say then subject to but not limited to purchase contract, prelim, and appraisal. So I really have an out if I needed it because the lender can add conditions.
Well, it's not like you're sending stuff through DU and, all of a sudden you're getting a true one just subject to an appraisal.
Oh, I am. I'm submitting loan files. I'm either running it through DU or more often I'm submitting a loan file to a lender and getting them loan approval.
Yeah, but you're still putting those words in. I would think if they're coming back, your wholesaler, with a pre-approval that, unless they put some sort of condition in there, that you get a pretty straight deal.
Yeah, you do, as long as there's not something awkward in the file. Norwest, now Wells Fargo, puts in their approval letters subject to any additional conditions that may be added.
I love it.
Or subject to
subject to the wind.
Audit, which can flag a whole new set of conditions.
Yeah, right, absolutely. Because all you got to do is find one little tiny thing, and they've met the condition of it.
Yeah, and I had a 95% deal that did get audited, and we got around the challenges, but in the end, when we were removing their loan contingency, I didn't write a letter. Rather, I faxed them the approvals and said, let's go through it together. And when we got to that line, I just said, hey, if they find that anything that you've given me isn't so, or something's changed, or the 50 grand shows up in a bank account, we're going to have a problem. So
they were all doing a real intensive audit before it went to settlement.
Yeah, we submitted the loan with a VOD, an account of $3,000, and they somehow called another bank and accessed that account. So obviously they used the borrower's Social Security number with the with the telephone number, and found out that in fact there wasn't $3,000 in that account. There was $23,000. Came back to me and said, "Where'd the money come from?" And according to the client, it was a gift from their folks, but it had been all cash, and they couldn't document it.
Oh, they couldn't document it the other side.
They couldn't document
it. They said it came out of a mattress.
Exactly.
So you find a lot of Orientals, and in those cultures, they deal with that stuff there. They deal with tongs, and they don't know what a bank is.
On a predominantly cash basis. But we worked it out. We got the money out of the account. They'd used some of that money to put it into title. We got that money out of escrow. We got a documented gift for the funds they needed, and we made the deal work, but it was aggravating.
Well, let me just ask you in a general sense, you might want to get more specific. Are your deals hard to put together? And by that I mean vis-a-vis a typical conforming loan, maybe of some complexity, but nonetheless a typical conforming loan.
Well, I mean, my average deal size is well into the jumbo category. In terms of the underwriting, I would say half of them are somewhat complex, and 20% are a little brutal, in that someone may not only be self-employed, but they may have filed different Schedule Cs with different company names as they've been evolving a company, and all of a sudden in the last year, a corporation may show up that typically should have a 2-year average, so we got to go back to an accountant, get the accountant to give us a common web of these different entities so we can end up with 2-year, 36-month averages to get the income we need. So yeah, there's some of that. And I have some files that are 4 or 5 inches thick, some files that are so thick we have to split them into 2 loan folders because of tax returns.
I would think you could be on the positive side of that. I think there's a lesson for the listeners out there that if you can build the knowledge base to handle those type of files in a market like yours, you've found your fortune.
Yeah, you have, particularly if you have the benefit of a refinancier, so you can direct mail that segment of the market to capture a client base, and then try to work that client base so they stay with you and refer you on to their family and friends.
Do you find that you see a lot of that now, where you're getting referrals into the...
Always, yeah. I get at least a call or 2 a day.
A day, wow.
From old clients. And one of the reasons for that is because I've intentionally tried to maintain an adequate sophistication level relative to underwriting, but I also really take care of my clients. I never screw them. I never charge them too much. I stay within market numbers, and I'm with them. And if they've got a problem, I take care of it. And when they call me, I call them back as fast as I can. I'm always just working my phone. Even when I'm out of town, I'm checking my voicemail regularly, just because I don't want to leave anybody hanging. I know that when someone wants a loan, they want it, they need it now. So responsiveness is just vital. And
it's funny you said that. I do a lot of interviews, but in the last week I called 2 of the top 10 people in the industry, names I gave you that are not on tape here, and they call me back very quickly. And these are people doing 800-900 loans a year.
Yeah, it's important. You have to be responsive. That's what people want, because often a bar is sitting there with a list of names. First name to call back has a good shot at the deal.
Right. When I was in business, I used to tell realtors, look, give your 3 names out, but all I want is the first call. I figured if I could get that first call, then I would get them.
Yeah. I try to get the realtors to give out 1 name.
Yeah, well, we might have to edit that tape. They're supposed to give 3 out. Although we all know, I mean, realistically, a lot of realtors today, they comply with the law. They say, okay, here's 3 names. I really like Jimmy, and so the fix is in anyway, and even though they comply with it. And the fact of the matter is that in your business, in the amount of range that you're dealing with, If you lose a loan, you're going to lose $1,000 or $1,500 or whatever it is.
Like
but
3 or 4.
Yeah, but you're going to have a realtor out there who's going to lose a lot more.
Oh yeah.
And so they are dealing. You're dealing at a different level. Where if you make a mistake, you're really costing them some money.
Yeah, and I'm extremely
the kind they remember.
And I'm always telling them that what matters to me is that the deal closes for them. And if I have a problem with the deal, I'll drive the package to another lender that I know can do it.
Well, you've done that before?
You bet. I mean, I'm the first to tell them I've got a problem and here's a solution and here's how I can help.
Do you have a certain group of, and you can go into some names if you want, there's nothing proprietary about it, but is there a certain group of people, wholesalers, people that you find are easy to work with and you like the relationship? And again, you don't have to mention names if you don't want.
No, happy
immaterial.
Well, one thing I do, because of my average loan size and the typical sophistication of my client base, most of my client base, because they're rate sensitive, I'm extremely rate sensitive too. So I'm often chasing rate, no matter how hard the lender is to work with. I want them to get the best deal, and I don't want them to open up the San Francisco Chronicle on Sunday and see that Bart's not getting them the best deal.
Right.
So that's sort of the first order of business. But then certainly there's situations and niches that only a few lenders can serve. And on the high-end loans, I work very well with Bank of America and have been successful in getting a lot of exceptions done and 80% loan-to-value loans up to $2.5 million. So that's been a good relationship for me. I also use Greenpoint, formerly Headlands.
Sure.
Stated income and high loan-to-value lines of credit that are odd for one reason or another. Maybe they're stated, maybe they're on second homes, maybe it's a 4-unit building, something that's unique that doesn't allow it to fall into a cookie-cutter situation.
What, do they whack it at an extra 0.5% or?
Half or maybe even 350 basis points, but if it allows, often we're using these as the equivalent of a bridge loan. It's a high loan-to-value equity line that's bridging someone from the sale of one house to the purchase of another.
You've raised an issue here that is taking place in the Washington metropolitan area as we speak, and that situation is there's virtually no inventory in certain segments of the market. One of the regional managers that I interviewed runs about 8 offices. He told me personally he has like 260 people that he has pre-qualified sitting in his drawer for realtors for which they cannot have a home. The point I'm leading to is that when contracts are put in, a lot of these people, especially in the new home, they're not accepting any of these kick-out clauses or any kind of a thing. You better have your bridge in place when you're putting the contract in, or be able to carry the whole deal.
Yeah.
And I wonder if you're seeing that out in your marketplace.
Every day. A couple things. I mean, first of all, our application to closing ratio is way down because the typical house is getting somewhere between 3 and 13 offers, and each one of those offers is typically pre-approved. So we've got many pre-approved files sitting here that people aren't finding homes, but ultimately they typically do, or else they decide to stay where they are, and then they need debt against that house to remodel. So that's an issue, but we try in all instances to, in the case of a pre-approval, to set the situation up where the borrower is formally pre-approved without the sale of their house, which often involves initially getting some sort of a second or a line of credit against their existing house. Or,
what someone else told me yesterday or a couple of days ago, I was doing an interview. They're getting agreements on the new home contracts now that if they cannot sell their home and don't have enough money to bridge that they will lease it, so that there's enough money to cover the payment so that the deal will go through. And then what happens later? They don't care. The builder's got his money.
In our market, it's so tight that kind of an offer would not get accepted.
Well, when
the borrower's pre-approved or they're not.
No, they really.
Yeah.
That's amazing. Just because of the
values in many neighborhoods have doubled in 36 months. There's such a demand that a new home builder, they don't care if someone doesn't have their act together. They'll just take the next offer.
You're probably not selling, I would imagine, your area. Are you in the city down near
I'm in Marin County, which is just north of San Francisco.
Okay. Mm-hmm.
So it's suburbia San Francisco.
Right. No, I know exactly where it is.
Average home price in our county is around 550,000.
Mm-hmm. Have you operated in that market since you started?
Yes.
And I'm assuming that when you started, what, with the average of what, 250, 300,000?
Yeah. It was half. But my major marketplace is the whole Metroplex, so the entire Bay Area.
So you will go in. So you'll go down to Market Street if you have to, or Union Square.
I'll go to Gilroy, which is south of San Jose, and I do many loans in L.A. and other areas, and I do stuff out of state where I'm allowed to. But the majority of my business is in the Bay Area.
Mm-hmm. So you have broker's license. So you're approved outside of California?
Yeah, we're approved in a number of states, and some states allow you a couple deals each year.
That's right, without bricks and mortar.
Through your own bank, yeah.
All right. Huh, I find it very interesting. How many people do you have working for you?
2.
Just 2 of you?
2 that work just for me. And then we've got other folks in the office that support other loan originators.
Do you, I use the word differentiation. In your particular market, obviously where you're in competition with other loan officers, how do you differentiate yourself? Anything that kind of comes to mind?
Yeah.
Your access, I think, is an excellent point.
The easy way to differentiate oneself is with rate, although it's not necessarily the most intelligent from an income standpoint. But if need be, I'll go right to rate to take the deal off the street, particularly if it's a pre-approval that I've already done all the work on. But I also try to do it just subliminally through knowledge, expertise, being responsive, trying to work the best deal for them, walking them through different options in an effort to make them think that I know what I'm talking about and I'm smarter than the other guy.
It's funny. A lot of the people I interviewed, they talk in the same, the A-plus personalities of which you're one. They operate the same way. They will do a fellow named Rod Flowers, who's he does in the, I think, 70, 80 millions a year. He just refuses to lose a deal. He will do anything to get that deal, and he uses the same words you do. He wants to take it off the table because he does not want a competitor to get it.
Yeah.
He doesn't like cutting his rate. He'll do it now and then, but he will do anything short of murder to take that deal off the table.
I'm the same way, unless I don't like the client, and then I'll cut them loose. If they're pissing me off, I'll send them down the road.
I talked to the nicest woman. I won't mention her name. She's a branch manager for a large company who does over 400 loans a year, and she is nice and sweet and gentle. Total different personalities than you and me, and that's what she says. She says, if I don't like him, I just cut him loose.
Yeah, unless there's something critical going on in that it was a really strong referral from somebody that I need to take care of. Like if it's a realtor referral and the person's really tough to deal with, I want to maintain my credibility with that agent. So then I'll just roll over and take it. But otherwise, if it's sort of a soft referral and they're a pain or they're not responsive and they're not getting me stuff and I feel like they're wasting my time and they're really not going to close, I try to nicely send them down the road to somebody that could help them.
So you're probably doing both of you a favor, you and them. I think probably in those kind of income levels, you get that person, self-made people in command all the time, want things done their way. And I would think you're dealing with a clientele that are much less malleable and where you have to exercise some control.
Ironically, most of them are great. And part of that is because the real estate agents that I went after were the ones that I liked and respected and connected with, and they're typically good people that are solid and won't work with a client that's a royal pain. And in some cases, if they get a client that's a pain, they'll still refer them to me, and they'll tell me that, but they won't do the business. They'll refer it off to someone in their office, and they just let me decide if I want to deal with them. And often in the first conversation, people are maybe a little brash, but typically after 5 or 10 minutes on the phone with them, they become nice because they realize that I'm not pulling their leg and I'm going to take care of them.
You mentioned after talking on the phone to them, do you take every loan out in person?
No, I try to do it all on the phone. I try not to meet people.
Very interesting.
Because I view it as a big time expense, particularly if I have to drive somewhere. But I can say, in retrospect, with the long-term clients that I've had, the most loyal, in many cases, are the ones that I've met, and sometimes the ones that I had to drive the farthest to meet. But because my client, I can be I'm 30 to 45 minutes from San Francisco, and I'm 2 hours from San Jose in traffic. It's a commitment to drive down there and meet somebody.
Well, certainly San Jose. I've done that drive not very recently, heading from Union Square down to San Jose, and just hit a real bad time. I mean, it was like Washington traffic.
Yeah, and I probably would have a little bit higher closing ratio and a little bit higher return ratio with the loan apps that I mail out if I met everybody. And early on I did because I didn't have a pipeline.
Mm-hmm.
But I'm sufficiently busy that I feel like if I have to get up and leave my desk for 4 hours, I also might lose another deal. So it's a trade-off.
Yeah, but of course the trade-off, I'm not sure where there's much of a trade-off here because you've already established yourself with your realtors. I'm sure the realtors that are referring clients to you have pretty much pumped you up by the time they even get on the phone to you, and the referrals you're getting from your previous clients already know about you.
Yeah, except that the referrals that I'm getting from realtors are more often move-up buyers. So they have a relationship, or they have a friend, or they know of a lender.
And so how do you deal with that? Because you're dealing primarily on the phone?
Yeah. It goes back to being responsive and trying to add value. I'm trying to make them think that I'm smart and present myself well and talk rate if necessary, talk programs and options. I highlight the fact that as a broker I do have access to the whole market. Whereas if they're dealing with a lender,
sure,
they're losing that breadth.
Isn't it amazing? Now you haven't been around, so I'm an older guy, but one of the things that has continued to amaze me is how brokers have really taken over the mortgage market from mortgage bankers. They've slow. I think the latest figures I saw were brokers that were originating like 70% of the loans today. But I mean, even 7-8 years ago, it was not even that. It was 50%. So I mean, it's just an amazing growth with brokers.
But it makes sense.
Absolutely.
And you think about what Wall Street's created in the way of different loan options, and no one single bank or banker can offer that whole gamut. And so, if someone's talking to a bank direct and talking to a broker, and their deal's a little bit trickier, complex, they're going to see that the broker's just got many more arrows in his quiver than a bank will for solving their problem.
I think they're also more aggressive. If you don't do a deal, you don't get paid. Now, I'm not saying if you don't work for Norwest and you don't do a deal, you don't get paid either, but there's an aggressiveness that has been well documented. I'm not the first to say this with brokers. They just seem to really be aggressive and go after to give service to their clients.
Yeah, the typical broker originator is more entrepreneurial than a typical in-house originator. There's certainly exceptions to the rule, but the other thing, too, from a revenue standpoint, is brokers are so much more flexible with their overhead than a brick-and-mortar bank location.
Yeah, right. Bricks and mortar can, when things are going good and you're cranking volume, that can be fine. But any of us that have been around a while, and you've been around enough for at least, I would think, for 1 or 2 downturns, when you got that bricks and mortar and you got 40 offices out there and the curve turns, it can be pretty vicious. Well,
and it can be compounded if for some reason your secondary marketing department's not competitive. And what are the odds that you're going to be with the market being so fragmented? So it can really create some negative cash flow.
Yeah, that's a good point.
And the loan originators in a bank shop tend to get pressure to use that lender, and to not broker stuff or to not broker stuff on rate. And if they're in a high net worth marketplace and they've got sophisticated clients that happen to read the newspaper and realize that Bank A is 3/8 out of the market, it makes it really hard on that loan originator in the bank to do a deal if he can't broker.
That's right, because there's not a lot of flexibility there.
And I was working when I started out, for a mortgage bank that we had to get a senior member of the staff to sign a waiver every time we didn't send a loan in-house. And then when they started losing money, they started marking up the retail rate sheet by half a point higher than the wholesale rate sheet.
Wow.
So I was half a point higher than a loan brokered through my company from a wholesaler, and I went down and met with the senior vice president who wouldn't admit to that, but also wouldn't look me in the eye, and I handed in my resignation verbally right there.
You know, I worked for a company, it's funny you're saying that. I worked for a company years ago that'll remain unnamed. They were very large, and that's exactly what they were doing. They set up their own wholesale department, and to goose the deal, they gave the retail people a higher price.
Yeah.
And it was just inflammatory.
And that's not taking care of the customer.
No.
And it makes it hard for the retail originator to build credibility in that kind of environment.
Yeah, ultimately, when we get down to what we're talking about today, it is taking care of that customer and giving them service level. And for those listeners out there that are listening to you, I know what comes across to me is your concept of service level. That if you don't give good service and you don't return your calls and you don't get the deals through, you're not giving good service, and eventually you're not going to get business.
Exactly. And if you do provide a high level of service, you stand out, and you'll get referrals. And frankly, that's how I have most of 85% of the realtors that I have today aren't necessarily the same ones I started out working with. Rather, they're the ones that I've met on the other side of a transaction. They've been the listing agent, or they're a realtor that a borrower came to me referred by one of my existing clients, and I met the realtor that way. And just as a result of my normal operating procedures, they realized they liked that level of service, so they now refer me business.
You know what I'm kind of picking up in this is that that you seem to, not seem to, but you have a knowledge base in your market. I consider your market, once you get up into over 350, 400, I consider that a niche market unto itself when you're talking loan amounts. And you seem to have a knowledge base of how that works with clients. That's a very sophisticated market, and you seem to know it well.
Well, thank you.
Anyway, well, look, I would like to end on a high note. I wanted to thank you very much for taking your time to talk about that segment of the market. It's a very unusual market. You may not think so living out there and collecting all those deals coming in, but it is a segment of the market that's unusual, and we don't often interview people that deal at that level. So I wanted to thank you very much for taking your time, Bart, and we'll be talking to you later.
My pleasure, John.